And our thanks to Bloomberg's David Westin and US Treasury Secretary Scott Bessent. I'm Vonnie Quinn. Welcome to Bloomberg Real Yield. Let's look now at those treasuries, and we've seen quite the turnaround today. Treasuries selling off after the Truth Social about 50% EU tariffs going into effect June 1st this morning, rallying again with a 30-year now at 502.58. You'll remember back on Tariff Onslaught Day or Liberation Day, we saw 502 as the peak. So we are actually just slightly above that right now. You have the 10-year yield back down to 449.51 and the 2-year yield there at 396.35. So a little bit of buying as we approach the last 2 hours in this trading week for the bond market. Now let's get straight to our guests for fresh reaction to everything the US Treasury Secretary said. Joining us now, Priya Misra, Portfolio Manager at JPMorgan Asset Management, and Gennadiy Goldberg, Head of US Rates Strategy at TD Securities. Lots to talk about. He mentioned the three-pronged approach, tax, trade, deregulation, and that tax permanence was going to give great certainty to this market. But then he went on to say he's not particularly worried about what the market is thinking, because the market could be thinking this bill will create growth, which he sees in quarters at 3% plus. Priya, what was your main takeaway from this interview?
So I think Secretary Bessent gave an optimistic, calm, he is the cheerleader for the Treasury market. So I think it's good that he didn't sound too worried. He did highlight the level of the 10-year. So I think this idea of the Bessent put or the Trump put on the 10-year, I think it's there. What struck me was what he didn't talk about. He didn't say that the trade deal with the EU is going poorly. So I think he's also trying to project confidence around getting deals with some of our largest trading partners. Let's see if this negotiating around the 50% actually results in a trade deal. On the deficit, I think it's interesting. The deficit is not a concern if we're at 3% growth. And I think he's trying to shift the market to saying the deficit may be an issue as it is, but if growth is picking up, and that's where that deregulation comes in, then maybe the deficit's not a concern. But I have to say, in that three-legged stool, the market, the equity market, the bond market, is squarely in that three-legged stool, and all three have to work. And that's what we have to see, if I take a step back, is the economy, how does the economy handle uncertainty, which Secretary Bessent has called strategic uncertainty. We think that's going to be a headwind to growth. So I struggle a little bit with how quickly do we get that 3% growth, given uncertainty, given an effective tariff rate. He also talked about tariff revenues, which tells you that tariffs are here to stay. Hopefully not at a very high level for the economy, but we don't know. And if it is 10, 15%, it brings revenue, but it is a consumption tax, whether the corporate sector or the household sector has to bear it. So I think, I think he did try and calm the market down around deficit all week since the downgrade. We've been talking about the deficit, fiscal fears, and then this morning it was back to trade. I think he tried to take the temperature down, but it is going to come down to the fundamentals of demand and supply for long-end treasuries, which I think is an open question, and the economic outlook.
On the fiscal gap, he did mention that we'd see something with a 3 in front of it by 2028, which is looking out quite far. But on the trade, he didn't give too many details. You have to wonder, did he even know that Truth Social was going out this morning? He said, I expect that we will be negotiating with them, meaning China again. That's not very confidence-inducing. He also said that he expects that over the next couple of weeks we'll have several large deals announced. Gennadiy, that doesn't give the market much to go on, does it?
It really doesn't. And I think this is where the problem comes in. I think the market assumed this détente was basically the end of it. I view this as being in the eye of the hurricane at the moment. We're still not quite out of the storm just yet. I think the market is trying to move on spectacularly. What I thought was interesting from what Secretary Bessent mentioned was he did bring up SLR, which I think the markets are looking at very closely. He did say that was worth tens of basis points, and I think that will be. What he didn't bring up, in my mind, the interesting thing, was potentially lowering long-end auction sizes to help keep long-end interest rates a little bit lower. That would be the big driver.
Would that be necessary, Gennadiy? I know you just come back from Europe. Is there less of an appetite for US long-end debt right now?
So I was on the road last week, and I can tell you from all the investors I talked about, only really a handful even mentioned doing anything different whatsoever. Most of them listed there is no alternative. We can't really get the liquidity that we desire. Our investment mandates just don't allow it. So there really is somewhat of a captive buyer base. But they are keeping the durations of their investments shorter. So they're going out into the shorter end of the curve and kind of letting the long end flail in the wind. I think the secretary has to look at that and really readjust the pace of issuance. Our base case is in the next couple of years, you'll see a lot more bill issuance and probably less supply in the 10, 20, and 30-year part of the curve.
And of course, we did see that 20-year auction earlier this week with a tail to it. I know you, Priya, have been very scared of the long end. That's literally your quotation. Are you continuing to be scared at 502 plus? And what level would that need to get to before the Treasury might consider, gaming out the system or issuing less?
Great question. I don't think there's a magic level. I think the Secretary Bessent and President Trump do look at the 10-year. So I think the speed, the reason why we're selling off, I think all of that will be important. Do other markets pay attention? I think we're at that critical point, 4.5 or so on the 10-year is right around the level where we have auctions literally every week. So you get a weak auction, you get a sort of sudden spike in interest rates. I think we edge closer to Gennadiy's point where maybe they have to cut back issuance. On your point, I think what is the role of duration in a portfolio? I think we're questioning that. Is there a supply-demand mismatch in the long end? If the Treasury doesn't cut back long end issuance, then I think that term premium, which is essentially how much more should we get paid to take on duration risk, is higher. That curve, 230 is about 100 basis points. It steepened a lot. I think some of that fiscal risk is getting priced in. But with such high uncertainty, as we're finding where's the marginal bid, that curve can continue to steepen. So we're still staying in the 2-year, 5-year. That's the part that's anchored by the economy, anchored by the Fed. I think further out, valuation is there, but I struggle with what the catalyst is for that curve to come down.
Before that Truth Social this morning, we were all looking at the dynamics on Capitol Hill and the tax and spending bill and the progress that we were seeing. And you certainly heard the Treasury Secretary say that he's not worried about debt dynamics because growth will offset any problems that we have. Is there any scenario where that comes true, Priya?
In terms of growth actually picking up where... if you get deregulation, I struggle with the lags, though. Typically, you deregulate, and it takes a year or two for that to show up. But productivity, that could be one. If AI is really, we're at the brink of labor productivity really picking up. I don't want to see it in the data. We're not seeing it. We're seeing an economy that's frozen into inaction. Is it a 90-day pause? Is it longer as we wait to see what the rules of the road are or of law before we figure out where to invest? So, but is there a scenario? Yes, I think we'd want to see it in CapEx intentions rising, hiring intentions rising. We're not seeing it, which is why I'm a little skeptical that we can get that growth.
Gennadiy, I want to ask you, who is most important to the bond market right now? Is it the Truth Social posts? Is it the Scott Bessent comments? Is it Jerome Powell, who we'll be hearing from again in a couple of weeks, but perhaps more importantly, in July?
So I think the issue is Jerome Powell is not going to tell us anything for at least the next few months. And I think that's been the tone of a lot of the FOMC speakers. What I'm really watching next is economic data. I think the reason the market's been so nervous about deficits is because there's been nothing else for them to be really paying attention to in the last couple of weeks. We've seen some of that economic data go through. This week has been quite light, so we're really paying attention to the deficit dynamics. And that's still the case. If you start to see economic data really start to slow down, you've had this uncertainty, you've had all the pulling forward of purchases by consumers. As you get into kind of Q3, Q4, and you start to see real underperformance there, I do think the market could actually view these levels as very, very attractive. That's the sentiment I keep hearing from investors. 4.5, 4.6 on 10s really do look like an attractive level. They're just worried about what the catalyst is going to be. Now, if the data starts to slow and you really see the economic numbers really start to slow down, I think you'll see investors actually pile in. And you may still, we're still expecting a steeper curve. So we're going to get a bull steepener on the Treasury curve as all rates come down and the long end just kind of lags. I think that's what the market's kind of struggling to remember here.
Well, speaking of which, we did mention global yields to Scott Bessent as well. David Westin questioning him about, the US versus the rest of the world. And I just want to add in something that George Saravelos of Deutsche Bank wrote this week. He talked about the Japanese yen. He said it's strengthening, and even as US yields are rising, and we consider this as evidence that foreign participation in the US Treasury market is declining. The bond-dollar correlation needs to be watched closely. It'll be the clearest signal of an ongoing deterioration in US bond dynamics. Now, Treasury Secretary Bessent said this is a global phenomenon. All yields are up. The dollar isn't weaker. It's just that other currencies are stronger. Who do we believe here, given that you saw with your very own eyes that Sell America is perhaps not actually getting implemented?
Well, the issue is it's the view that Sell America is a possibility, right? The Treasury debt should never really be questioned, and I think investors are really starting to ask questions, which is really a big problem for Treasuries as really the benchmark. We're talking about all global yields moving together. It's the Treasury market that's driving all of those yields. That's driving all those yields. We are the 800-pound gorilla in the room. So if we can get our fiscal house in order, or if our economic data really starts to slow, we'll probably see interest rates moving lower, led by the U.S. And then I think that's the big issue here, is that we are still very much the leader in global bond movement. And if we can get our rates under control, that will get reverberated throughout the globe as well.
And Priya, last word to you. I do want to ask you about the SLR change potentially this summer and what you think that will mean for yields.
Sure. So I think if it does come through, a lot will depend on the details. Is it just reserves? Is it short-dated treasuries? Is it all treasuries? Is it banks? Is it broker-dealers? So not to get into the weeds, but let's look at the details. If it is a broad-based easing in terms of bank buying of treasuries specifically and out the curve, I do think it brings that marginal buyer. What we've been all debating is who's the marginal buyer? Is it foreigners? You know, to Gennadiy's point, maybe they're not selling, maybe they're not buying. Do banks come in? I think if you get SLR easing in the most expansive form, banks might show up as a buyer, and that can bring in some demand for the Treasury market. We've all been waiting for that catalyst. Maybe it is the banks.
Maybe it's the third prong after all. All right, thanks to both of you. That is Priya Misra of JPMorgan and Gennadiy Goldberg of TD Securities. Up next, the auction block. European debt sales surpass 1 trillion euros in the quickest time ever, with American companies helping to fuel the gains with a record level of sales. We talk credit next. This is Real Yield on Bloomberg. Time now for the auction block, where we highlight the top stories for global issuance this week. We start with Europe and debt sales there across the region surging past €1 trillion for the year. That marks the quickest time ever. This past Tuesday alone saw the most issuers and tranches since January, and deal volume from May has reached the highest on record. Here in the US, high-grade sales were led by the likes of Siemens and Citibank, which pushes the monthly total now to more than $130 billion. This has been the fourth consecutive week that issuance has topped dealer forecasts. And in the US junk market, well, it's having its biggest month of the year. It's now crossed the $100 billion mark for 2025. CoreWeave, of course, the big highlight of the week, pricing $2 billion of 5-year notes. The deal upsized there. It also drew orders almost 5 times the original size of the deal. And speaking of credit, JPMorgan CEO Jamie Dimon spoke about it earlier this week at the company's Investor Day.
Personally, and I don't like making forecasts, stuff like that. I am not a buyer of credit today. Okay, I think credit today is a bad risk. I think that people who haven't been through major downturns are missing the point about what can happen in credit.
Joining us now, Peter Cecchini, Principal and Head of Research at Axonic Capital, and Neha Khoda, Head of US Credit Strategy at BofA Securities. Neha, let's start with you. Given what Jamie Dimon just said and the amount of appetite that there seems to have been in the last couple of weeks, who's getting the better deal, buyers or sellers?
It's the age-old question, right? So, look, it's as of April, never happened. It was a giant April Fool's month. We rallied right back to pre-tariff tides. But then the other macroeconomic conditions haven't really gone back to the same levels as we saw pre-Liberation Day. So tariffs, for example, are not back to the expectations that were set in March for us. Same with some of the other parts of the market. As our previous guest said, term premium has been climbing. The 10-year, 2-year part of the Treasury market has been steepening, and for the wrong reasons. We are not really seeing that much economic growth, and so the question really is, how does this bleed into the credit market? So this is the one part that I have my eyes on. It's high yield. It's doing fine in terms of the demand, but rates are becoming a problem for the credit market. We as fixed income investors have gotten used to credit spreads sort of cushioning the blow from rates, but as this week was a stark reminder, this is not always the case. So Wednesday, for example, rates jumped 5-10 basis points, spreads were wider into it, and as a reaction function, high yield yields are now positively correlated to the Treasury yields, which again, it changes how you think about portfolios. So I think, yes, in a nutshell, demand is there, technicals are very solid, but the nature of risks and then the nature of volatility agents has changed.
Yeah, Peter, what kind of an environment are we in? Because certainly after April 7th and the tariff onslaught, we saw a very different market reaction. It seems to be much more orderly today, even with the threat of massive tariffs on the EU.
You know, I think Jamie Dimon's comments about sort of a generation of investors that have been conditioned to a bounce is quite apt. And I think we are seeing that. When I look at high yield spreads, CDX high yield, for example, around 350 basis points, look, while off the tights, when you think about the totality of the circumstances and the new risks that are currently on the table, a forward implied default rate of about 3.5%, when the trailing 12-month default rate is closer to 4.5% when you include PIK restructurings and so forth, doesn't seem like that appropriately prices risk. Tariffs obviously add a degree of uncertainty. The fiscal setup adds a degree of uncertainty. And by the way, I think the administration has it right. We can't afford to continue to run $1 trillion in interest expense for eternity. So fiscal austerity is actually required. And frankly, Vonnie, I was really interested to see that when the budget, the big beautiful bill hit and was passed by the House, that 10-year rates or yields actually rose, because I think there was a hope that there would actually be a little bit more fiscal austerity in the bill. So there's this tension between sort of this long-term need for more fiscal austerity and sort of the idea that there will be a bit of a needed detox in the meantime. And that's our expectation going into the second half of this year, that we are going to see a slowdown, and that in general, the riskiest asset classes are not pricing that in.
Peter, if you agree with Jamie Dimon, it almost sounds like you don't particularly believe the Treasury Secretary when he said earlier that, all is going to be fine. We're going to have growth offsetting anything negative, and the fiscal gap is going to just keep narrowing.
Well, it's a bit, Vonnie, about timing. Sometimes there's a little bit of short-term pain in order to get long-term gain, and any athlete can tell you that, you're going to hurt after a hard workout, but you'll be in better shape a year from now if you keep going to the gym. And I think that's kind of what we have here. Fortunately, and I loved David's interview with Secretary Bessent, where he focused on getting something done in SLR this summer. That is meaningful because the banks, I think, really are the source of supply for treasuries, given that there has been some foreign deposit capital flight from U.S. banks that oftentimes will require them to lighten their treasury holdings to fund that deposit flight. And certainly SLR is one lever they have to quite quickly make sure that the long end of the curve is well managed.
Neha, is there a way to try and take advantage of any dislocations? So, for example, if you look into sectors, there's a bit of a misalignment when it comes to auto manufacturers, for example, with equity versus credit. Same with energy. Is there a way to benefit from those misalignments?
I think that's exactly the way to go about that in this market, because as you can see, volatility is high. Investors had sort of put tariffs as risks behind them, but then this morning we saw that that story is far from over with new threats of tariffs against Europe. So the nature of the market today is that we have to take advantage of those relative value dislocations. So our advice to investors is that you stay nimble, you go back and forth between fixed and floating rate, layer in loans, and really look at the dislocations across ratings, sectors, even asset classes, which we actively track. So I would say that making a unidirectional call is actually really hard, given the nature or the wide range of outcomes of the economy, and it's really relative value that's in the spotlight right now.
Exciting times. Thanks to both of you for sharing your thoughts. That is Neha Khoda of Bank of America Securities, and of course Peter Cecchini of Axonic Capital. Still ahead, the final spread, the week ahead. It's a holiday shortened week, of course, but plenty to watch out for, including Nvidia earnings and that PCE data. We'll have a look next. This is Real Yield on Bloomberg. Time now for the final spread, the week ahead, and it is a big one. Coming up, we have, of course, an easy day Monday, Memorial Day and May Day in the UK, so US and UK markets are closed. We have the ASEAN Leaders Summit beginning as well. And of course, Powell speaks at Princeton. Unlikely he will say too much to roil these markets, but we'll be listening very closely nonetheless. Tuesday, US consumer confidence and durable goods, very important, plus earnings from AutoZone and Xiaomi. Wednesday, though, all eyes will be on Nvidia earnings. That stock has been sort of trading in a range for the last month or so. We also get Fed minutes. It'll be interesting to see what the discussion really was mostly concerned about last time round. And then retailer earnings. It'll be interesting to see if the consumer has been changing any of their habits given what we learned this week. Thursday and Friday, plenty of key data, including GDP, jobless claims, PCE, the all-important one, and personal income and spending data, Michigan confidence too. And we get more earnings from the retailers. And for my final thought, let's look ahead to that PCE inflation print, because of course Gennadiy Goldberg saying that this market is going to be looking back at data. That's going to be what's going to be guiding this bond market in particular over the next several weeks, not just tariffs and that three-pronged approach that Treasury Secretary Bessent talked about. So calling for the Fed's preferred gauge to rise more modestly in April than the CPI data. Economists expecting the services heavy index to show a cooling due to deflationary pressures in less tariff exposed areas of the economy. So we'll see if that comes to pass. Core PCE year over year looking to come in at 2.2% and month over month just 0.1%. Here's how bond markets look. That 30-year yield rising today. This is Real Yield on Bloomberg.